Hi everybody, welcome to the latest in our series of webinars, Tips and Takeaways for Business Resilience. My name is Malcolm Palmer. I'm the Managing Partner of A4G Chartered Accountants. I'm your host today and I'll be your third speaker as well. Our other two parties on today's event are Jarmans Solicitors and Richard Cox Wealth Management. First of all, for those of you that don't know us, a little bit about A4G. We're based in Kent. Our main office is in West Kingsdown, up near Brands Hatch, but we've got clients all over the country, and perhaps like many of you, distance has become less of an issue in the last 12 months with all of the calls and meetings that we've had on Zoom with all sorts of different people. Our dedication is to own and manage businesses. In fact, we have a mission statement that says that we want to be the best, but not necessarily the biggest, all-round advisors to owner managers. That is all about providing advice, support and planning. In fact, one of the things that makes us different than most firms of accountants is that we'll always say it's all about the advice, not just the numbers. For all of our clients, we have a two-person approach to their affairs, which means a principal advisor, who is the person that they will go to for their advice. They'll do the pre-year meetings and deal with those calls when you're in a bit of trouble and you need somebody to lean on. But then each client has a client manager who will oversee their affairs, their end-of-year accounts, their management accounts, all of those sort of things. So just to let you know about the way things will be working today, we're going to be answering all your questions at the end. So there should be a Q&A button at the bottom of your screen. And if you write your questions there throughout the webinar, then we'll come to them at the end. Occasionally, there might be sort of 2 or 3 questions on a similar theme and we'll combine our answers on those. But, feel free to throw any questions in there at all. So here's our 3 speakers today. Jay Sahota is the Senior Partner of Jarmans Solicitors, myself and Richard Cox, who's the Principal of Richard Cox Wealth Management. So I'm going to start with my old friend Jay Sahota, and Jay is going to be giving you some tips for debt recovery. So just give a few seconds for the handover.
Morning all, thank you very much, Malcolm. Thank you to my mutual bearded friend, actually. We're looking like brothers, aren't we, today? I'm Jay Sahota, the owner of Jarmans Solicitors, and my little motto is making your legal problems disappear and giving you peace of mind. I'm going to be giving you some top tips, I have to be careful how I say it, some top tips for effective debt recovery. And these are tips really I've come up with over my 18 years in practice as a litigation lawyer. And I've always said you need to get this formulative stuff, the precipitative stuff, right at the start of a business relationship and when you're carrying out your business journey. Otherwise, you end up with massive problems later on. Believe me, as a litigator, I see massive problems if these sorts of formulative foundation type things aren't got right right at the start. When you're setting up a business and when you're reevaluating your T's and C's and how you do business, really, really important. Otherwise, as I say, legal phrase, things can go Dolly Parton in a hot air balloon, i.e. tits up. So you need to, excuse my French, so you need to make sure that you get these things right. And obviously because of COVID going on at the moment, it's especially important that people manage their cash flow and look at how they're managing their debt and how they're chasing their debt to make sure they're being proactive. And it's a top fact that 65% of companies at the moment are blaming poor debt recovery for their cash flow issues. I'm sure Malcolm will agree with that. So you really need to make sure that it's sorted out. Otherwise, it causes massive problems down the line. So I'm going to give you a quick rundown of 10 top tips. And feel free to make notes as you go along. Some of them are intertwined, and some of them, as you go through, you'll see there's a theme. They refer to having really good terms and conditions in place, because that's so important. So this does intertwine with terms and conditions, the importance of really good, robust, tight terms and conditions. But unless you have those as the platform, then you can't feed these debt recovery mechanisms into those terms and conditions. So they work alongside each other effectively. So number one, really importantly, when you're about to embark on a business relationship with somebody, make sure you carry out a risk assessment. I'm still amazed as a litigator at the number of people who want to trade with company X and they do no checking at all. I don't know why you wouldn't do that. I mean, you do it in any other context or scenario. It's a bit like marrying somebody without having engaged them and dated them first. I mean, it's just ridiculous. So make sure you look online, look at their reputation, see what people are saying about them. Look on Trust Online, that's Trust Online, which tells you whether a company or individual has had a CCJ against them in the past. Also, look at the Insolvency Service website, which is very useful actually, and it gives all sorts of tidbits of information in there. So the Insolvency Service website is a really good one-stop shop for all sorts of data, not just whether somebody's been bankrupt or the company's been insolvent, but it sometimes gives other information as well. And as I say, if you have any red flags about the reputation, do look around at reviews, etc., and what people say. If there are any red flags, then approach their previous customers. Sometimes they'll have details of people they've traded with in the past. Ask them and say, look, I see there's stuff online about you. Is it true? Can you give me a response? And if you aren't happy with the response, then another tip is to follow your gut instinct, really. If something doesn't feel right at the start of a relationship, this is a general tip for business, not just debt recovery, then either don't do it or do it in a modified sort of fashion. So that gives you an indication that something might be going wrong down the line. So make sure you modify your relationship if you need to. So that's the first tip. The second tip is related to it, but to do credit checks. And I've had many cases in the past where people have failed to do these credit checks and then suffered later. So make sure that you do your credit checks and use a reputable supplier. Sorry, excuse me, I feared this might happen. My knob is vibrating. When my radiator gets to a particular temperature, my knob vibrates and makes a lot of noise. Excuse me, I'm going to leap up one tick and just turn it off. Huge apologies. I don't think you've ever heard of a vibrating knob in a seminar before. So, well, I'm a litigator. I'm used to dealing with these situations. So two, do your credit checks. Look at Companies House. See what's going on with the directors, their background, any other companies they're associated with, what have they been up to. Look at the addresses. As I say, look at any related business transactions going on, really important. And get a credit reference. There's many suppliers and providers out there. I will say discreetly, don't use Dun & Bradstreet, because I sued Dun & Bradstreet once because their credit check wasn't very good, and we won repeatedly, and that was a great day of victory. So get your credit references, get your credit checks, and look at the websites that are out there. There's lots of free websites that do credit checks on a particular entity you want to trade with. And as I say, really get your information right before you do it. You wouldn't do anything else without checking those sorts of mechanisms first. They're really important. Number three, who are you dealing with? Again, I see as a litigator that people don't know whether the entity they're dealing with is a company or a sole trader or a partnership, or an LLP. So you need to make sure that you know who you're dealing with. One, importantly, so that you can modify your terms and conditions as a result. And two, you know that who you'll be suing if you need to sue them. Because otherwise people can hide behind all sorts of veils. So make sure that you know who you are dealing with. And I'll come on to a point about directors and personal guarantees later, quite an important point actually. So it's very important to know the makeup of the entity you're about to engage with. Number four, I mentioned terms and conditions earlier, really, really important. Make sure they're robust and tight in any event. So you have in normal T's and C's, who's going to deliver what or do what, when you're going to get paid, how you're going to get paid, what happens if you don't get paid, termination, breach, those sorts of things. I'm going to say as a lawyer, aren't I? But don't put a template off a website because they don't work. They're not bespoke to your particular business. So get your terms and conditions bespoked, if that's a word, and make sure they're fit and proper for your business. Otherwise, you will have problems later. The number of clients I have coming back to me and saying, oh God, I pulled the template off, lawyers.com and it was rubbish. And now I need to modify all sorts of things. It really doesn't work. So make sure you get it right. And that's a big tip. That's really important. Number five, there's a little tip actually that will give an addition. One tip I will give you for your terms and conditions is having those a comprehensive credit policy. What I mean by that is what happens in the event of non-payment, and on what terms you're going to extend credit. So that's important as well. And one thing we've got in our terms and conditions actually, which is something I inserted only recently, is that I say in those that if a client does not complain about a bill, well, luckily we get mercifully few complaints, does not complain about a bill within a particular length of time, for us it's 14 days, then the invoice is deemed accepted. And there are legal arguments about whether and to what extent that's enforceable. But if you have a mechanism in there and say that if a client or customer does not contest a bill within a certain amount of time, then it's deemed accepted, then that does help later. It's not 100% watertight, but it will help you later, because then you can legitimately say, well, if you had an issue, you would have raised it earlier, wouldn't you? And if it does go the whole hog and go further, then it's very good evidentially. So do put that in. Number 5, as I've said before, look carefully at the customer or supplier you're going to enter into trade with, and modify the risk accordingly. What I mean by that is if they're high risk, take that into account in your terms and conditions with the sort of stuff that I've been talking about, the credit policy, terms, risk, time for payment, etc., etc. Or look at the way you deal with them and change the way you deal with them. This is really important. Don't be scared to do that. If you say to the other entity, actually, I'm going to modify what I was about to do because I've seen an adverse credit rating or somebody's given you a negative review, and they say, no, you can't do that, then you know that either you need to walk away or it's certainly a massive red flag. And usually, as I said, trust your gut instinct and use that as a marker for the relationship that may be to come, and probably don't do it actually. So modify the way you're going to deal with them. What I mean by that is, for example, take direct debits instead of taking payments just ad hoc as you go along, or take a big upfront payment, for example. Or foreshorten your terms so that the event of default on their part is slightly easier to cross the threshold into, if that makes sense. So don't give them too much leeway, basically, if you see any red flags there. So do trust your gut instinct. If there are any red flags, then my advice usually is to walk away, because it means that business relationship probably isn't going to unfold in the right way, basically. So that's an important one. Look carefully at the customer, and if you need to modify the relationship in some way, then do. Please don't be scared to do so. If you are scared, then that probably isn't a good sign anyway, and nor is it a good sign if they come back and give you lots of blowback. So that's number 5. Number 6, this is really important. Look at different forms of protection. People don't do this often enough. And probably the biggest takeaway from the whole of today is look at things like personal guarantees. What I mean by that is if you trade with a limited company, it's called a limited company for a reason. The directors have and the owners have very limited liability. So what you might want to do is get a personal guarantee from them, again, in your terms and conditions, or as a separate document, which is embedded within the terms and conditions, saying that the directors stroke owners of that company give a personal guarantee that if the debt isn't paid by the company, then they will pay that debt. For example, if the company goes belly up. And that means that even if the company goes under, for instance, then the directors are personally liable for that debt. And I've used this as a mechanism with lots of disputes over the years. We've sued individuals who are involved with the company when we've not been able to sue the company for one or other reason. So that's really important. So personal guarantees. And also you can get credit insurance. Not many people know that you can get credit insurance. So if you combine those, and that's a very powerful mechanism actually. So do get different forms of protection. Number 7, when you're looking at protection, there are other ways of doing it as well. Particularly if there's red flags, but in all cases, I would look to take a deposit. There's no reason why you can't ask for a deposit or a payment up front, an advance payment. You know what it's like otherwise, particularly professionals. You do a job for somebody, they will then moan about the bill down the line. Again, it doesn't happen very often, but they will, hence my comment about the sum being deemed accepted, and then they won't pay your bill and you've got no money in advance. I mean, as a law firm here, we operate a policy of monies on account. And what I mean by that is we take monies on account from a client, say, look, we need fuel to put in the engine of your case. And it means that your cash flow is being managed, Mr. Client. And then we will bill you as we go along. And those billing monies will effectively be set off against the money you've already paid, monies on account, which means that you're not standing there with a massive debt down the line or waiting for the money to come in, which can then cause so much debt and it becomes an issue, as Malcolm will tell you. So make sure that where you can, you take a deposit or an advance payment, or look at getting a guarantor, for example. I mean, this is quite novel, but in one of my cases at the moment, we have another company guaranteeing the debt of company X that you're trading with. So look at either a personal guarantor or a company guarantor to guarantee that the would-be debt of the company that you're trading with. And you know, that's a really big thing as well. That cash up front is really, really important. Number 8. This is something that people don't do often enough, but if the other side do have trouble paying, talk to them. What a lot of people do is the other side will say, well, I can't pay it now. Can I pay it in 3 months' time or whatever? And the company will not ask why that's happening, what they can do to help. Is there something going on in the background? Is it part of the wider climate? We know with COVID at the moment, there's lots of stuff going on, but build up that rapport and that relationship. Again, if you're scared to talk to them, that probably isn't a very good sign at all. So if people are late paying and they have trouble paying, start talking to them immediately, take immediate action, do something straight away, send a reminder, ask them why it's late, tighten your terms if you need to. Again, people are really scared of doing this, but tighten your terms if you need to. And that communication is so important. Just talk to them and ask them why it's happening, what's going on. And they will, again, if they're being earnest with you, they will present the facts as they are. If they're not, then you know they're not being truthful with you, and you can modify the relationship. Linking back to your terms and conditions, that should be in those terms as a reason for termination if somebody isn't being full and frank with their disclosure. Again, fairly novel, but I've drafted that for some clients. I say if you go to the other side and ask them for particular information and they don't provide you with the information, they're not being full and frank, then that's a reason for you to terminate the business relationship. So all these things work as a mechanism together. So that was number 8. Number 9 is linked to that, obviously. Be proactive. Be proactive at all times, otherwise you'll be seen as soft. And you might want to consider, in extreme cases, withholding your services or deliveries or not providing a service. Be careful, because it again links back to breach, so you don't want to be in breach yourself. So you need to have a really clear evidential trail of what's going on and why. But you might want to consider stopping your services or deliveries, or providing the service that you're providing, or stop doing business in extreme cases. That is an extreme measure, I know, but again, make sure that it's caveats in your terms and conditions, otherwise you will be in breach. But in extreme cases, why would you carry on providing services or goods for somebody who is just not paying you? As a policy, again, as a law firm here, if a client doesn't pay us within a certain time, we stop working for them. We say, we're not working for you unless you put some more money down, because otherwise you just get debt heaped upon debt, which isn't good for anybody. So don't do that. So you might want to consider stopping doing business in extreme cases. And also make payment easy. I mean, I see this all the time, actually, where people will send out bills and they don't even have bank account details on them or an address, or phone this number to make payments. And they send out an invoice and wonder why they're not getting paid. So have mechanisms on your bill, on your T's and C's, on your reminders, whereby you clearly set out how you're going to get paid. So make payment easy. That's, again, another big thing to bear in mind. Make payment easy. Often people don't, and they wonder why there's an issue with debt. So don't make it difficult for people to pay you. I mean, there's all sorts of mechanisms. Malcolm will know this. With Xero at the moment, it sends out automatic reminders. Once you've sent out your invoice, and it will remind people to pay you. Even before the invoice is due to be paid, it will say, bear in mind, Mr. Plumber, you're due to pay your invoice the next day. Please make sure you do. And then it will send out regular reminders. It's a really important one. I'm sure Malcolm will give you more information about the sorts of things that he's working with. Number 10, don't leave it too long. Again, I know these last points are fairly similar. Don't leave it too long. Otherwise, the other side will just think they can get away with it. Every inch you give at that crux point is really important, because they will think they've got away with not paying your debt. So make sure that you are proactive very quickly and very early, even if it's via a conversation. Otherwise, they'll think they've got away with it. And you give them that little leverage then, and it will ruin the whole relationship later. So make sure that you're being quite robust with people. And when you are chasing, again, this will need to be in your team's terms and conditions. Make sure you add chaser costs and interest. You can only do that if it's in your terms and conditions. There is a provision in the late payment regulation, which means that you can add certain amounts of interest and costs, but they're tiny, actually. So it's helpful to have mechanisms in your terms and conditions whereby you can add your own chaser costs, your own interest. And again, you can't do that unless it's prescribed in your trading relationship. So make sure those are in there, because if you think about it, you're chasing a debt. Sometimes it takes days, months, weeks, years to chase a debt. All that time, energy, and effort you're spending. And if you're not adding interest and chaser costs of that, and then you're ending up doing a deal with them at the end of the day and saying, do you know what, you owed £500, pay us 400. You've lost so much money with the additional time and energy you've spent that you might as well have written it off, basically. So make sure you add those chaser costs and interest, because they can mount up and be fairly significant. And they're a very good leverage for negotiating as well. If you say to somebody, I'm going to add all these interests and all these costs and all this time I've spent, you need to pay soon. Otherwise, the amount's going to be X, not Y. It's going to be much larger. That can often be good leverage for speedy payment, actually. Really good leverage for them to pay quicker. Some quick COVID tips. I'm coming up to the end of my time. That was quick, wasn't it? Hopefully enjoyable. Quick COVID tips, which are particularly germane now with what's going on at the moment. They're relevant anyway, but particularly important now. One is that you may want to do deals. So say to people, actually, I know you owe, I don't know, £1,000, but we'll take £900 for speedy payment. So they may want to pay less now or more later. So that's usually a good mechanism to get people either pay a lower amount immediately or actually a higher amount later. Say, actually, it's not going to be £1,000 later, it's going to be £1,100 later when you add in our time, energy and effort of chasing. So you've got your choice. So either way, you're not suffering. And people will often take the first option and say, do you know what, we'll pay it now and pay you a bit less and do a deal, because it's cash flow in the door, isn't it? Really, really important. So those deals can be quite important. Particularly with COVID, as I said at the moment, upfront payments are really important. Please put those in wherever you can. If the other side says no, you know there might be something wrong. Why would you not give an upfront payment? Particularly where it's professional services. So make sure that you take an upfront payment or a deposit where you can, money on account. One tip I came up with a number of years ago, which I've used quite successfully in a few cases, is that, and it's quite nuanced, but you might want to have a term in your terms and conditions whereby if the other side don't pay your debt and you end up suing them, you might want to have a term in your terms and conditions that they will not oppose default judgment. What I mean by that is if you sue them and get judgment in default because they don't respond to the proceedings, sometimes people kick up a stink and say, I never got the proceedings, I'm going to contest it now. You will be protected if you have a clause in your terms and conditions saying that the other side will not oppose that judgment made in default of a defence. So they will not oppose judgment in default. Otherwise, they can kick up a hornet's nest later, and that can be quite useful, actually. So make sure that you're getting these tips in place. Otherwise, as I said, I see so many disputes. Make sure you get your terms and conditions right, please. Link it with effective debt recovery. Be proactive. Try and implement as many of those tips as you possibly can. Think about things early. Think about managing your cash flow early. And again, trust your gut instinct. If you know that things are going to be a problem, then don't enter into those sorts of relationships. And if you're finding that you have debt recovery problems, then be proactive early. Otherwise, it will be a massive problem later. And take advice. If you need to take advice and you're in a bit of a sticky situation, take advice from your accountant, your lawyer. It doesn't have to be me. And make sure that you're sorted out early and proactively. Otherwise, it's going to be a massive problem later on. So yeah, those are my top tips. Hopefully they were useful. I know I sped through them, but they've been useful for me in practice when advising lots and lots of clients in different sectors, companies, types of business, and they do tend to work, particularly when used as an amalgam together and combined with really good terms and conditions. So please make sure that you follow those because it will prevent issues later. Any advice that you need, I'm happy to answer any questions. And I will now hand over to my very good friend, Richard Cox. Thanks very much for listening. Take care.
Good morning, everyone. Thank you, Jay. A really interesting talk, all about building good foundations. That's a theme that will run through the next 10 minutes, where I'll give a general overview of considerations around financial buffering. So before I start, I'd like to give a little bit of background about me and why this is an important subject to me. So I worked as an investment manager for 20 years. I've met management teams around the globe, focusing on corporate actions, how companies grow, how they evolve. And alongside this, it was my job to manage and spot potential risks to companies, both internally and externally. I now work as a financial advisor, as an appointed representative of St. James's Place Wealth Management, and I provide personal and business advice. And their resources and support have proved invaluable, especially this year when keeping abreast of the 100-odd changes to various government schemes, something that I'm pretty sure has been very difficult for you to manage as business owners. So why is it important to look at financial buffering, and why even more so now? So when I first start to look at a company, I create my own SWOT analysis. So looking at the strengths, the weaknesses, the opportunities, and the threats. In fact, Jay's talk really focused very highly on those threats, recognizing those threats and dealing with them. Now, each company is going to have a unique combination of the four, but it's really important to do one of these on a regular basis alongside a business plan. So why COVID? Why is it important? Well, COVID and Brexit, they've created uncertainty, and that often magnifies the impact of threats. It creates threats that you may not have even considered before and highlights any weaknesses within your company. Now, business resilience really relates to understanding and eliminating the threats and minimizing the weaknesses so that you can better use your strengths to take advantage of the opportunities that are out there. If you have good business resilience, you're going to be more adaptable. You're going to be able to take advantage of opportunities. Maybe that's having fewer competitors in the place next year, or looking at new avenues to growth. And if you can build this, there's going to be less time spent putting out the fires in your business. Now, in my experience, most business owners, they spend so much time in the business that they don't actually consider the threats and weaknesses until they're upon them. So firstly, how do you create a buffer? Well, let's start looking at internally, and it's something that Jay highlighted. It's important to be on top of budgeting and cash reserves. When I meet with individuals, I talk about having an emergency fund, a fund to cover the short-term unexpected events. I kind of look at 3 months worth of total income. That's kind of total expenditure, sorry, that's normally what I recommend. Well, the same's there for business. A business should have a buffer. It should have an emergency fund. And there's no hard and fast rule as to the multiple to use. And that entirely depends on the regularity of cash flow and how certain it is. And the more uncertain, the greater the reserve you should hold against it. In those meetings with individuals, I often talk about their business and their personal situation. Many business owners seem to think of them in isolation, but it's really important to consider the interplay between the two. In September, I sat down with a business owner, and he was talking about what happened when lockdown began. He had one client, and that was 65% of his income. He spent the whole year networking and diversifying his customer base. That reduces risk. And back to Jay's point, that also means that you'll have less impact of a single debt not being paid. Diversifying is key to reducing risk. That can be supplier, customer, investor, creditor, whatever that is. It's important to recognize that last year things have changed. So maybe supply chains have been disrupted. I mean, Brexit, that disrupted supply chains back at Christmas. And it's important to keep on top of that. It's important perhaps to keep more stock in your business, making sure that any of these threats don't have such an impact on your business. You could, in fact, consider stress testing some of these scenarios. Often, business owners unintentionally ignore the risks that are right in front of them, the threats to business. Now, Jay's mentioned a few of them. What would happen to your business if a key or vital staff member, perhaps shareholder, became seriously ill or worse, died? Now, you'd probably not be, well, I don't know whether you would be surprised, but if I told you that over half of businesses ceased trading within a year under that scenario, it's a big number. And this type of risk is insurable, as are many others. And it's really important to consider. Another good way of creating buffer, and especially going forward, is by retaining good and productive staff, being able to hire well. So it's important to recognize that staff productivity and happiness are often tied to financial stability. After COVID, people, I think, will be a bit more worried about the future. We talked just before this about mental health and stress and anxiety. They may put greater value and emphasis on benefits packages that a company provides. So we've kind of talked about the internal, but what about the external? What about some of the things we can't necessarily control? So it's really about understanding and recognizing threats but also the opportunities that are there. And I want to focus on 3 areas. I mean, there's so many areas we could focus on, but I want to focus on 3 areas to consider in this regard. So last year, well, clearly the big thing was COVID and the impact of COVID. Now, I mean, I hadn't heard of furlough, bounce back loans, C-bills at that point. But one thing that's important to consider perhaps is what goes forward. How does the world look going forward? So how are the government going to pay back debt? And these are my feelings about things. These are my opinions. But maybe we see a changing tax landscape. That could include higher taxes. We don't know what they might be. Maybe it's corporation tax. Maybe it's capital gains tax. But that's going to affect how we take business and take money out of the business and move it around. It's going to affect our exit strategies. I also think we're going to see higher taxes perhaps on environmental issues. I think Brexit's an interesting one. You know, we're going to see, are we going to have the supply chains that we had? Are we going to be able to source our goods? How are we going to source goods? And then funding costs. A lot of banks have lent money, and are they going to be repaid? And if that money isn't repaid, could we see higher funding costs down the line? I think we're going to see a more complicated tax landscape. And for a business owner, it's going to be increasingly important to consider your tax efficiency and also the awareness of tax reliefs. I know that A4G are doing a talk in a few weeks about research and development tax credits. It's an area that many people don't think that they can claim on, but actually they can. We're also going to see a change in working habits. So many people work from home now. So is that going to continue? Is flexible working going to be a thing that continues, or is everyone going to walk back into the office on June the 21st? That's going to have an impact on you as an owner. Can you cut costs? Can you downsize the office? Do you have to be more flexible? I think that unemployment could rise, and the government, once furlough finishes, and the government could well offer businesses incentives to hire apprentices, perhaps offer training schemes. And one thing we mentioned earlier, I think Malcolm said, they've changed one thing in Zoom and it's completely discombobulated me. Well, first off, last year, who even knew of Zoom? Who even knew that what we would be sitting here today having a conversation across a computer? So the uptake of technology has been huge last year. And we've seen lately high street retailers who haven't embraced online and they're struggling. So it's important to consider the technologies that are out there and use them to your advantage. They are an opportunity, but it also could be a threat to your business. One of the things that's happened with inflation last year is it fell, and it fell because supply side inflation dropped, because we're not driving cars, we're not going out and shopping. But what happens now? There could be a pent-up demand. I was reading yesterday, it's expected that you could see 2% inflation by the end of the year. And how does that affect our businesses? If we sit with cash on the balance sheet, it's going to be depreciating at a faster rate. It's important to consider what happens to our input costs because of inflation, and we need to have a buffer for that. If rates go negative, we could end up having to pay for our own bank accounts. So finally, the third point, during COVID, we've seen environmental issues come to the fore, and I think that this will continue. I believe, much like the Industrial Revolution and Tech Revolution before, we're moving into the environmental revolution. We need to consider how customers, suppliers, and investors view sustainability. It's going to be an opportunity to stand out from your peers, but it's also going to be a potential threat should you ignore it. So I always kind of like to finish with a quote, and I found this yesterday, and I really think it's apt. Resilience is all about being able to overcome the unexpected. The goal of resilience is to thrive. The more you look at these things and the more you understand them in your business, the better your ability to take advantage of those opportunities that are there. Now, I hope this general overview has given you a few things to think about when building financial resilience. All of your businesses are unique. If you'd like to explore any of the topics covered today, feel free to reach out. And I really look forward to answering any questions you have during the Q&A. Thank you. Over to Malcolm in the studio.
That's brilliant, thank you. So, and unfortunately, no vibrating knobs from our second speaker. So, just give me a couple of seconds for the sort out my technology, and then we can have our presentation. So, right, here we go. So, yeah, that's great presentation from Richard and Jay there. I just need to quickly swap something around. That's better. Hopefully that all works now. So the 12 vital ingredients for success in 2021. Now, this is based on some stuff that we've been using for years and years, actually. There was a massive survey that was done, I think it was 30 odd years ago, that identified the 10 most common causes of small business failure. And I don't know if any of you have heard of somebody called Charlie Munger, but I'm sure you have all heard of Warren Buffett. Charlie Munger is Warren Buffett's right-hand man. And apparently his favourite saying is, "Tell me where I'm going to die, and then I won't go there." And so these 10 most common causes of small business failure, we've used that as a way of helping people identify the places that they shouldn't go to. And then as time's gone on, we've sort of updated them and flipped them around a bit so that they're to turn them into the 12 vital ingredients for success. And then I think in 2021, these are going to be more applicable than at any time, really. So the number one thing is to have clear vision and goals. It's so easy day after day to just have your head down, dealing with whatever problems come that day. And occasionally you just need to step back and follow a very simple strategic planning process, really, which is identify a timescale. We used to say 5 years. It's just too long now. Maybe a year, 2 years, but where do you want to be at the end of that timescale? And what's in it for you? Is it a better lifestyle for your family, or a bit more time, or just, a bit of personal pride, enjoyment in what you do? What's in it for you? That should be the thing that gets you up in the morning. And where are you now? Now, whenever we ask this in a strategic planning session, we get a tale of woe, because everybody tells us all the disasters that they're having to deal with at the moment. But having understood where you are now, where you want to be, what do you need to do to get to your destination? And what's stopping you? Sometimes it can be something very trivial that is stopping you from doing the big things that are going to make that difference to your life. Tip number 2 is to get the roles right within the business. So I don't know how many of you have read the E-Myth Revisited. Everyone at A4G has read the E-Myth Revisited. It's almost compulsory reading, really. But the E-Myth talks about 3 different types of people: technician, entrepreneur, and manager. So the technician is the guy who gets the thing done that the business does. That's, most of you will have come from that, in a job, and you had what the E-Myth calls an entrepreneurial seizure, and you decided you could do it better than your boss, and so you set up. But essentially, your history is doing whatever it is, whether it's accountant or financial advisor or solicitor, etc. And then you become an entrepreneur. You've got to learn these entrepreneurial skills, and then your business starts to grow, and then you take people on, and you realize you need to be a manager as well. So we all sort of steer towards one a bit more than the other, and that can be a bit dangerous. So you need to be a bit of an all-rounder. If you've got a partner in the business, sometimes people go into partnership because they're not comfortable doing all of those things. And sometimes you can find yourself in partnership with one of these sort of 3 types of individuals. So a claustrophobe is somebody who is very good at what they do and is quite entrepreneurial as well. So they've been able to go out and sell it. And as a result, the business grows. But then all of a sudden, they realise that they've grown to their limit, and they just have these day after day of being incredibly busy and extremely claustrophobic about their life. The second type of person, the introvert. Now, they're a good. They know how to do the job, what work involves, and they're good managers, but they're a bit shy. They don't go out selling. So they've got this amazing little business that nobody's heard about. And then the third one is the outsider. Now, outsiders are interesting, really, because these are people that don't have a background in that industry. They can't actually do the thing that the business does, but they've got good managerial skills and good entrepreneurial skills. Now, if you're in partnership with one of those 3 people, whatever the thing is that they can't do, it's going to fall to you to do that. And you can get some quite good little partnerships going between, 2 out of the 3 of those people, really. Maybe it's an all-rounder. If they're an all-rounder, the danger is they might not need you. They might be able to do it all themselves. So partnerships end up taking on these sort of strange dynamics sometimes when, you can have one dominant personality and the other one just ends up sitting back, taking half the profits and doing nothing. So I'm sure there'll be people on the webinar today who are in a partnership and have difficult relationships. The next thing is you need to build a great team. So, if you don't build a great team, then you can quickly become a prisoner of your own business in that everything is dependent upon you. The question is, what sort of people do you employ? Now, the publisher Felix Dennis, his book, he talks about always employing people that are smarter than him, people who can do the things that he can't do. That's always a little bit dangerous, because you might think that they're smarter than you, but actually they're making all sorts of mistakes and you don't realize they're making them because you don't understand what they do. So, you know, the control freaks amongst you, and I plead guilty on that one, would find that a little bit dangerous, employing people like that. Maybe just focus on employing people that share your values, so that you know that you're going to be, you know, generally speaking, aligned and going on the same path. That's important to avoid conflict within the business. And then if you can build up some great systems, you can train those people on those systems, and now you've got a team that are all pulling in the same direction. The next of our tips is what we call the 5 Ds of management. So the first thing is, you know, as a manager, you will find yourself doing lots of things, and often hard workers are the ones that get themselves through to a manager level, but actually what got them there to that point is not what's going to take them on to the next level. So you just need to be very careful about, you know, if you are one of those head down, really hard workers, that actually you don't find yourself just with more and more stuff piled on you. Because it's critical that as the business grows, you need to be able to delegate stuff. You know, it's a, you know, everybody says to somebody who's busy, you need to delegate more. I think we all know that's harder than it sounds, and it's finding those techniques for delegation. And one way you can do it is directing, where you've got somebody who works closely with you, and it's do this, do this, do this, do this, do this. We take on trainees straight out of school every single year. We took on 4 this year. They won't be on the webinar, but I will say to them, they are actually the best group we've taken on, perhaps in 25 years of practice. Absolutely amazing what this little group of teenagers have done since they joined on the 1st of September. But for those sort of staff, you need to direct them and take them through one step at a time. Sometimes you will have employees who just don't want to do the things that you need them to do, and you may need to toughen up a bit and just make some demands of them. Sometimes you need to have what I call the chat, you know, where all the hints and cajoling has failed, and you just got to demand that they do the job that you're paying them to do. Your business can settle down into a bit of a pattern, but it might not be the pattern that you want. Occasionally as manager, you've got to step in and disrupt things slightly and just go, this is not working, this is not having the outcome that we want. But with that team, you've got to communicate the goals, so keep it clear. We have this mission statement: we want to be the best all-round advisors to owner managers. And everybody understands that. It's this other thing, you know, a BHAG, a big, hairy, audacious goal, something that everybody can buy into. Even if their understandings of it slightly different, they're all going in roughly in the right direction. And then give somebody their roles. So everybody, all the roles in our practice are all clearly defined, what the priorities are, the responsibilities within that, and then those roles are allocated to different people. But you must understand what's in it for them. Some people have careers and some people have jobs, and that's not based on what they're doing. That's a state of mind. You know, are they, you know, do they have great ambitions to do what you're doing, or to, you know, go on to other things maybe, or is it just a job for them, you know, one that they balance with the rest of their life? If you don't understand what's in it for them, then it's very difficult to get any kind of mutual way of working that's beneficial for both of you. But in terms of those goals, what is critical currently? So Google have this thing where they revisit their goals every single quarter. So start of every quarter, everybody knows what are the critical goals for the coming 12 months. Great customer service, you know, almost goes without saying, and this is going to become even more important in the next 18 months if economically, you know, we start to dip a little bit really. So, you know, just define what is good customer service and what is great customer service. Make sure your team know that. Make sure that they take ownership of problems. This is where Disney are amazing, you know, that any Disney members of staff, even if it's their job is to empty the rubbish bins, they are taught to take ownership of any little problems that they see and sort out the guests, etc. Attention to detail, some people have it, some people don't. If some of your team don't have it, you need to teach it to them. You know, these things can be learned. And train them on that customer service, you know, maybe some role play type things. The next of the vital ingredients is accurate measurements of performance. So hopefully you've all got monthly management accounts. You know, the typical thing might be 15 to 20 days after the end of the month. Your account system will almost certainly produce them. They may be a load of rubbish. It all depends on whether the advanced controls have been done, you know, whether your bookkeeper understands even what they are. So this is the sort of thing we help clients on a lot. We actually log on to people's Xero systems and do it for them, but other times we'll just teach them how to do it. We try and drill that down for a lot of the clients we have a close business relationship with into weekly income calculation. So at the end of every week, they know what their income they've generated that week is. A little bit harder to calculate for a service business, but it is doable. And then those weekly meetings that you have to discuss that, the changes you make as a result of those weekly meetings will be cumulatively the things that will help you achieve success. Key performance indicators are the day-to-day things which will determine how well you're doing. So, you know, in simple terms, a recruitment company that I have, that I've acted for 20 years, they just have the number of appointments that they've made that month. That's their key performance indicator. If they hit their target, they know that everything else will work. Just remember, your focus is your reality. So whatever those numbers are, if you focus on them, they will almost certainly improve. And improved results means improved profits, which eventually should result in improved cash flow. But, you know, I know some of you have had a bit of a kick in the last 12 months. So the first thing you need to think about is, you know, if you've got some problems paying people, is this a cash flow problem or a profit problem? It's easy to just say, oh, we've got a cash flow problem. But actually, it may be just that you're losing money. You need to address that underlying profit problem. It may be that you are not solvent anymore, that your liabilities exceed your assets, that you're unable to pay your debts as and when they fall due. There is a lot of legal implications of that. It's the sort of question you should be asking to us. If you're not solvent, you're past the point of no return, there are remedies involving an insolvency practitioner, perhaps. What about the next 30 days? You know, is there enough money coming in to pay the bills? And then after that, funding growth. So, you know, hopefully you're going to benefit from this £125 billion of savings that have built up in the last year that just burst into try and be spent. But you may have to fund stock, work in progress, equipment, etc. So are you able to fund that and also pay back some of the loans that you've built up? A sound sales and marketing strategy is going to be crucial. So I say there's only 5 aspects to this. Get ready for new customers, which is mainly about ensuring you've got a really good database and that you are capturing all potential customer details. Inbound marketing, so inbound marketing, you know, website stuff, search engine optimization. Outbound marketing is you going out and finding them, so mail shots, e-shots, you know, you going to look for those customers rather than trying to make them come to you. And perhaps the one that is the most successful businesses, but that they don't really think about, is referral marketing. Who are the people that know other potential customers who can then refer you? And lastly, if you get these leads, what about your sales technique? You know, there's a whole other presentation on this, but lots of people most business owners have never read a sales book, but, you know, just buy one. The 1 Minute Salesman, great little book. You can read it in 3 hours. Your sales skills will massively improve as a result. Whatever you're doing, you know, you can't forget there is competition out there. So who are the big players in your industry? What do they do which is better than you? What can you change? What can you learn from them? And how can you compete? Lastly, how do you keep up to date? You know, used to be, we all had these trade magazines that we read regularly. These days, it's all on the internet. But, you know, are you actually allocating some time every week to keeping up to date with the developments in your industry? So, if all's going well, then hopefully you'll be enough work for you there. But as the business grows, this, as we all know, is where things start to break down. Efficient systems are critical. So are the roles clearly defined? Are responsibilities on each of those roles clearly defined? Are there any systems you need to document? So I was once somewhere where they told me that they had nothing was documented at all in terms of any instructions. And I went to the bathroom in the middle of the meeting, and I came back and I said, I have found a written instruction. And I'd taken this off the wall. It had been laminated and stuck up with blue tack. And it said, please don't put the paper towels down the toilet. They block it. Are you stupid or something? So somebody thought that was so important that they laminated this instruction, and yet the main activity that the company did had no instructions for it at all. So just writing something down is very powerful, making sure that people have access to it, whether it's on their computer or on a piece of paper on the wall or whatever. This is how franchise operations like McDonald's have grown so quickly. So, that is an absolute whistle-stop tour through all those 12 issues. It's almost 12 different presentations on its own. If you'd like some help from us, we have a number of breakthrough programs that we do. So we've got one which is for startup businesses, taking you right from the very first days through to over those first couple of years to hopefully a successful and profitable operation. For businesses that are looking to grow, helping you identify all those limiting factors and the things that will stop you from growing and how you will break through those. The freedom program is for business owners who want a little bit more freedom, either be able to step back from the front line a little bit or potentially sell their business. The recovery program is for businesses that have hit the buffers and need to turn things around. I know there's more of those out there now than there would have been 12 months ago. And the last one is the virtual FD program. So for those of you that are not big enough to have a finance director or a management accountant, that's the sort of service that we can provide a few hours a month just to fill that gap in. So thank you for joining us. I'm going to stop my presentation now, and then hopefully my illustrious colleagues will all appear, and and we'll have a little look at the questions. Hi Richard, hi Jay.
Hello.
Now I'm gonna have to put my glasses back on here just to have a look read the Q&A answers.
I wish you guys had given me a call about the beard, I have to say,
Didn't get the memo.
It's very fashionable, you see. So let's have a quick look. So Jay, I don't know if you can see the questions and answers here, but the first question is probably for you, really. Do you have a feel for the level of statutory demands waiting to be turned into formal petitions post 1st of April? And do you expect Rishi to extend the breathing space afforded to companies?
Do you know what? It's a really difficult one, actually. Will he? I don't know. There's been much talk about it. I do empathise with those companies, but you've got to look at it from both sides of the equation. I mean, we were talking about the stamp duty holiday earlier, weren't we? There's always a bit of a quid pro quo. It's good for some people, not good for others. It's great for people who are about to fall off a cliff edge, not so good for conveyancers. I think the same thing with statutory demands. I mean, yes, there probably does need to be a bit more breathing space, but on the back of my talk, how good is that? Is it, for the people who are expecting the money? So it's always a bit of a balancing act, really. I mean, we see it. The government have a very hard balance to achieve at the moment. We've got it with the property legislation as well at the moment. So, tenants are getting more and more rights. Landlords feel as though they're being deprived of those rights. Where do you draw the line? So in short, who knows, really? Yes, ideally more breathing space, but then how long are you prolonging the agony when the inevitable might be around the corner anyway?
That's a good point. So while I've still got you there, Joe, there's a question here that it may be one for all of us, but what would you suggest if you have a difficult relationship with your business partner? So maybe we'll give you first we can all have an opinion on this. So we'll start with the legal one first.
What was the start of the question? Sorry, Malcolm, I didn't quite catch the start.
What would you suggest if you have a difficult relationship with your business partner?
That's a really good question, because I've been there actually, in the context of a law firm. Some of you will know. I hope none of my former colleagues are in attendance. You've got, it's communication. You've got to sit down and talk about it. I mean, you have to go right back to the beginning. If your shareholders agreement or partnership agreement is drafted properly, then in the face of such problems, you should be able to deal with any situation quickly. If you follow your gut instinct, let's face it, we usually know if a relationship isn't going to be right, we usually know at the outset that it doesn't feel right, something's going to go wrong. You're not communicating properly, somebody's doing more work than the other, somebody's taking more money than the other. So you generally know. I've dealt with loads of partnership and shareholder disputes over the years, and when I asked them that question, did you have an inkling at the start? 99% will say, yeah, I did. So if there's an inkling, don't do it. It's as curt as that, really. If you get there and there are issues, then there should be a mechanism in the agreement, if you need to go that far, for dispute resolution. I advise clients to have their mediation clause or an ADR clause, but start talking early. Start talking about horrible things early. Have it all out. Again, you should be doing that at the start of the relationship anyway. Communicate, have it out as you go along. If it gets very messy, then resort to the mechanisms in the shareholder agreement. And if you need to look at legal options, then start looking at legal options. But I think the key is to not hide issues and start talking about them very quickly, bring them out into the fore. And if there's an issue, then invoke the mechanisms in the agreement that you need to, basically. So it's never easy, and it will depend on the circumstances, but talk early and try and bash through the issues. And if you can't, then the writing may be on the wall.
That's interesting, saying that. Our experience often is, of course, most people go into partnership, and it's all lovely and wonderful at the start, isn't it? And because of that, and all they're focusing on all the positive things, they've never had a proper conversation about how things will work. And our experience of partnerships has been that if you actually force people to have that conversation about the partnership agreement on day one, it's quite possible that they won't go into partnership with each other. And therefore, actually getting the partnership agreement done makes it less likely you're actually going to need it. Conversely, so yeah, I don't know if Richard, I don't know if any of
I just think what Jay said about communication is absolutely key, and times do change and businesses evolve, and therefore it's important to have a regular communication and keep up to date with each other's expectations. And I mean, that's not just a partnership you have in business. That when I meet customers for the first time, I lay out their expectations of me and my expectations of them. And as long as you have that already, you've got the right people in the right places. I think that's kind of how I look at it.
Yeah. I did a strategic planning day many years ago for a couple of guys in the business, and they clearly had different goals, and one wanted to develop a new bit of kit for their industry that was going to be revolutionary. The other one just wanted to have a good living because the business was not providing that. So I let them kind of argue it out, and they settled on when the business was on a sound financial footing. And they both kind of sat back in their chair. This would be when they would then get involved in developing this product. And I said, no, guys. I said, you're not off the hook that easy. I said, what's a sound financial footing? And the guy who wanted to develop the machine said, well, when we haven't got anybody knocking on the door demanding money. And the other guy said, well, when we're earning 150 grand each and they've got £100,000 spare cash in the bank. I said, we haven't quite got an agreement here, have we?
I think also it takes a lot of courage sometimes to actually to say this relationship may not be for me, and that is part of the problem at the beginning.
Yeah, I think that's where you need a third party. Almost some of the business sessions we've done, I have felt like a relationship counsellor occasionally. But you just people are a bit frightened after a number of years to actually address that problem. So there's a question of what aspect do you think owners find most difficult when considering business resilience? So I'll throw that to Richard, shall I?
I think so many people are working in their business, and I think that's the hardest thing, is to actually get them to lift their heads out of the business for a little bit and remember they're a kind of general surveying the field, and therefore actually the hardest thing is probably to actually initially start the planning process. Once you actually start it, you kind of then get the benefits from it, but it's hard to, I think the starting point is the hardest. it's always hard to make that first step.
Yeah. I'm not going to answer that question because by a remarkable coincidence, my Friday night email that's going out tonight, we've been doing a series of videos with Roger Black and Steve Backley, and it's about the 20 stages of their mind setting program, and resilience just happened to be the one slide. So if you're not on our email newsletters and you'd like to be, just ping an email into A4G and you can read my musings on resilience this evening. So Jay, I think this is probably for you. What in your experience is the most common reason for non-payment?
Usually because the other side's a bugger, excuse my French. It's not usually
That's what I was thinking.
It's not usually because they can't pay, actually. I mean, sometimes it's because they can't pay. It's often because they're being difficult. I mean, in my experience, when I've had disputes about people not paying each other, the entity who is not paying actually is fully able and capable of paying, but they don't want to, and they want to be difficult. As I say, it does happen that people genuinely cannot pay, in which case all that stuff about negotiation and discussion is really important, that I mentioned earlier. But often it's because they don't want to pay. They want to use some sort of leverage. Well, we're not going to pay you until you do X, Y, and Z. They're just trying to modify the terms of the agreement, or willy waive, as I call it, another legal phrase. So usually there is a it sounds a bit trite to call it arrogance, but there's usually a bit of an arrogance about it, and they just don't want to pay. In which case, I think it's a red flag, as I mentioned earlier, for the relationship not working, and they need to do something about it. I think usually about 70% of cases where people don't want to pay, as opposed to cannot pay, and the other 30-odd% are where they physically cannot pay, in which case you need to reassess what's going on anyway.
Good. So just two questions left. The last one I think is probably for me, but maybe I'll throw it at Richard as well. But the second one just is, after having carried out a SWOT analysis, where should I begin? Okay, so for those who don't know what SWOT analysis is, it's strengths, weaknesses, opportunities, and threats. I don't know whether that's been done by somebody using an external advisor or a template. But yeah, any tips from your perspective on that?
Yeah, I think, obviously there are some things that are going to flag up. There's some of the threats that are going to be extreme risks to your business, and clearly you've got to look at those quickly, but often it's what's right in front of you. So I meet with individuals, but one of the questions I will be asking is, do you have a will? Now, 50% of the time they'll say yes, and 50% of the time they'll say no, but they'll caveat that no with it's been something I've been thinking about doing for a while, and that I think those are the things that you can immediately do something about, and they will flag up quite quickly if you do step out of your business or out of your personal situation and survey. I think Jay will probably entirely agree with that.
100%. Yeah, most things are staring people right in the face. Actually, they don't need to delve deep into their personal affairs of the business, and most things that people just probably are scared to do, actually, they don't want to confront them, and they put them off again and again, or they think it's unnecessary, or it's going to be really costly, or they'll get around to it at some point, and it isn't important or whatever. And those things are often the most important points and the most important things to do. I mean, I talk to clients about 5 or 6 things, which is the need for a will, terms and conditions, shareholders agreements, prenups, sounds a bit sinister with Valentine's Day just having gone, prenups or living together arrangements, and employment contracts. And people often think, well, no, we're not going to need them because everything's all fine. But you those things that you don't think you need, I mean, there's a reason you need them, is that you don't think you're going to need them. So get them sorted out.
Yeah. The number of times you hear someone say, started my business and I know I should be putting into a pension now. I think when people start their businesses, they don't look after themselves and they forget some of the things they had in full-time employment, and they're really important for their future. Yeah, for sure.
I think, exactly what you're saying. Often, the most obvious thing is right in front of you, isn't it? But it's often too big for somebody to do. So one of my team has talks about, the first thing you've got to do every day is eat the frog. Oh, how do we eat the frog? Well, it's like eating the frog. That's the most difficult thing to do, isn't it? Okay. And but sometimes, the frog is a bit too big to eat in the time that you've got available. So you put it off to tomorrow, and you never get there. So we've sort of broken that down into okay. Once you've identified what the frog is, at the very least, eat one leg of the frog first. You know, for me, if I've got a big project to do, it'll be like, right, I'll go into our the directory, I'll do a little search, I'll go through the notes of the previous meeting, I'll make a whole load of scribblings, and I'll just put it to one side. I've got some emails I've got to deal with and other stuff, and then I'll come back to it the following day. And just by starting early and not leaving it right up till it's absolutely critical, you get so much of a better result out of that.
I say to clients something similar about, you're not going to eat an elephant in one sitting. Absolutely.
Yeah, good. So the last question was just, what's the easiest way of doing cash flow? So I think we've got about an hour and a half left. No, I'm joking. Where do I begin with that? The problem with most cash flows is that they've been prepared just for the bank in order to get an overdraft, and they are, of course, a work of fiction, and they don't necessarily show what the what the worst point is going to be. They'll just show the start and the end of the month. So the 30-day cash flow is easier than you think. You can set something up like that just on a simple spreadsheet. We do a thing I get doing with our clients. We set up called the 5-minute cash flow. Now this is a retrospective look at comparing the end of last month with what you should have had. You start to see the trends, whether the surplus in the business is going up or down. That's quite a good technique. If you're on Xero, and I know many of you use Xero accounting software, there are some fantastic apps that are out there. Fluidly is one, Float, I think, a few of our clients use, is another. But some of this stuff will use data from your system and will help predict what your likely cash flow is, and then you can tweak it a bit based on whether you think things are up or down. And if that's not a detailed enough answer, ping me an email and I'll forward on a few details. So guys, is there anything else you want to add to that? So
not for me.
Everybody's probably bored looking at our handsome faces. So no, okay, maybe not. All right, well, so thank you ever so much to Jay. Thank you ever so much to Richard for today's presentation. As I said, if there's anything you wanted to ask and didn't get the chance to do so, I think you're all in contact with Amanda, so ping that across to Amanda. We're all easy enough to find on LinkedIn or Google if you don't know us. And we'd love to talk to you if you're interested in using our services. So many thanks, everybody, and maybe see some of you at a future webinar.
Thank you.
Take care. Thank you very much.